Welcome back to The Conscious Investor. I'm your host, Alex, and today we're tackling a topic that many high-level professionals whisper about but rarely discuss openly: the silent internal battle that dictates success or failure in the world's most intense financial arenas. We're talking about trading psychology, and specifically the power of mindfulness.
And I'm delighted to be here, Alex. My name is Ben, and for years I've worked with hedge fund managers and high-stakes proprietary traders. What I've seen repeatedly is this: a trader can have a flawless technical strategy, the best risk model and access to all the data in the world, but if they cannot manage the storm inside their own head, they will inevitably underperform. The mental game is the 80% determinant of success, not the chart patterns.
That is such a powerful statement, Ben. The 80% determinant. So let's set the context. You compare the financial markets to a vast open ocean. You can have the best ship, the best charts, the best technology, but if the captain, the mind, is unstable, the whole thing sinks. Why does this internal storm, this emotional gap, exist so fiercely in trading?
It's a primal conflict, really. Our brains haven't evolved to deal with Wall Street. Our limbic system, that ancient part focused on survival, processes a 5% drop in a stock's value as if a saber-toothed tiger were charging at us. That visceral, gut-wrenching feeling when a trade turns sour, that's cortisol flooding your system. It paralyzes the prefrontal cortex, the part responsible for rational thought, planning, and long-term risk assessment. When the amygdala, the fear center, takes the wheel, your meticulously back-tested strategy crumbles in seconds.
Right, so we're physically and chemically predisposed to make bad trading decisions. That makes perfect sense. And if we simplify this down, as many behavioral economists do, all destructive emotions in trading usually boil down to two core forces: fear and greed. Let's break those down, Ben, because they are the perfect recipe for buying high and selling low.
Absolutely. Let's start with greed. This is the engine of FOMO, the fear of missing out. It's a truly intoxicating, euphoric feeling that tricks us into believing this asset has gone up 200% already, but this time it's going to keep going. This is where traders over-leverage, ignore stop losses, and enter a position long after the smart money has exited. I worked with a trader, let's call him Mark. Mark had a great system for trend following, but one day he watched a particular tech stock mooning. His rule was never enter a trade after a 50% move in a week. But greed whispered, "Everyone is getting rich. You deserve this, too." He dumped his entire remaining cash stack right at the peak. Within 48 hours, the stock crashed 30%. He didn't just lose his gains, he wiped out his entire month's capital because his system was hijacked by that rush of euphoria.
That's such a painful, relatable anecdote, that uncontrollable desire to join the party. And the inverse of that, fear, is just as ruinous, manifesting as paralysis or panic selling.
Precisely. Fear is insidious. It stops you from executing your entry, which is analysis paralysis. You know the setup is perfect, but you just can't pull the trigger. And then the trade runs away from you. Or worse, it makes you panic sell a profitable position too early because you're terrified a small pullback will become a reversal. But the most destructive form of fear is the refusal to execute a stop loss. This is the denial of loss. You turn a statistically minor expected operating cost, say a 1% loss, into a catastrophic 15% disaster simply because your ego and fear refuse to accept the initial failure.
So you're saying that mindfulness meditation doesn't try to eliminate these natural emotions. You can't. They're hardwired. Instead, it creates a buffer. It teaches you to observe the Mark-like greed or the denial-fueled fear without reacting to them. It's the gap between stimulus and response.
That's the core expertise. It's like standing on the sidewalk. You see the car approaching. That's the market volatility, the fear signal. You don't deny the car exists, but you also don't jump into traffic. You simply let it pass and then cross safely. Mindfulness trains the mind to locate that internal position of stillness. It gives you that necessary pause.
Let's move to the next layer of complexity, which is often invisible to the amateur: cognitive biases. These are the mental shortcuts that served our caveman ancestors well, but which are deadly traps on the trading floor. We need to be able to detect them. You highlighted 3 common ones. Let's start with anchoring bias.
Anchoring is one of the biggest capital killers. A trader buys a stock at, say, $100. It rises to $150, then news comes out and the fundamentals change, causing it to drop to $80. The trader absolutely cannot sell at $80 because their mind is anchored to the original $100 entry price, or worse, the $150 high. They think, I shouldn't lose money on this, or it has to return to the high. The anchor makes the current reality irrelevant. They cling to an arbitrary point in time, turning a potential small loss into a massive capital tie-up, completely ignoring the new, objective data.
And this is heavily tied to ego, isn't it? The ego doesn't want to admit it was wrong about the anchor price.
Entirely. And the second one, confirmation bias, is the ego's best friend. If a trader is long, meaning they expect the price to rise, they will only seek out bullish articles, analysts, and tweets that confirm their current position. They actively filter out, ignore, or discredit any bearish reports or dissenting opinions. They are living in an echo chamber of their own making. This prevents them from seeing objective risks, leading to massive overexposure when the market finally moves against them.
It turns market analysis into a search for validation rather than a search for truth.
A beautiful way to put it. And finally, we have the availability bias. This is basing a huge leveraged decision on the most recent dramatic or easily available information rather than on a deep statistical analysis or your established long-term plan. For example, a crypto trader sees the last big rally from 2 weeks ago, a 50% explosion, and immediately thinks that's what's going to happen now, ignoring months of consolidating sideways action. They are reacting to the most dramatic mental snapshot, not the data set.
So how does mindfulness practically combat these invisible enemies? How does sitting still for 10 minutes make me immune to my own brain's evolution?
It's all about attention training, Alex. Think of your mind as the internet connection for your trading platform. Without mindfulness, you have dozens of tabs open: personal worries, an argument from last night, fear of losing, excitement about potential gains. That saturates your mental bandwidth and causes cognitive lag. Mindfulness is the act of closing those tabs. You focus all cognitive capacity on the present moment, on the chart. That non-judgmental observation skill, the ability to sit and just notice your brain anchoring to a price, that's the expertise. You create a separation. There is the thought of regret, and here is me, the observer, choosing to stick to the plan.
That leads directly to the neuroscience of discipline. You mentioned the prefrontal cortex, the seat of executive function, and the amygdala, the fear center. How does daily meditation literally rewire this relationship?
It's almost like physical training for the brain. Neuroscientific studies, which I find fascinating, have shown that regular mindfulness practice increases the density of gray matter in the hippocampus, which is related to memory, learning, and emotional regulation. Crucially, it reduces the density in the amygdala, the fear factory. So you are literally shrinking the threat detector while boosting the rational control center. When that red candle appears, the amygdala fires. But because the prefrontal cortex is stronger, it intervenes. The mind no longer screams, "Sell everything." It calmly states, "Red candle, it's within the stop-loss range. I must adhere to Rule B." That calculated pause is the difference between consistent profitability and impulsive ruin.
That pause is the discipline. It's what allows a trader to operate with the consistent, data-driven mindset of an institution. You used the great analogy of the U.S. Federal Reserve.
The Fed does not change its interest rate policy because of one bad day on the stock market or one sensational news story. It follows a roadmap defined by months of data, models, and long-term objectives. Profitable trading requires that same institutional mindset. Meditation helps depersonalize the loss. A loss becomes a statistically expected operating cost, not a personal attack on your intelligence or worth. It reinforces the neural connection between plan and action, eliminating that internal debate. What if I wait a little longer?
That's where authority and trust come in, right? If I can't trust myself to follow my own roadmap, how can I ever expect to achieve consistent results? Or how can others trust me if I manage their capital?
Exactly.